Okay, good afternoon. I see there's 19 of you already. We should start with today's tutorial on chapter 7, topic 5. Okay, so let's start with today's tutorial. I hope that you have your questions with you. We'll go through it together. All right, let's go through question number 1. We are evaluating a project that costs $644,000. All right, so putting down the cost first, $644,000. Cost $644,000. Has an 8-year life and has no salvage value. Okay. Assume the depreciation is straight line to zero over the life of the project. Sales are projected at 70,000 units per year. Quantity is 70,000 units per year. Price is $37. Variable cost $21. Fixed cost $725,000 per year. Tax rate is 35%. And the required return of 15%. Okay, so all these are the information given to you. So the problem here is cost is $644,000, depreciation straight line to zero over 8 years. So here is how you find your depreciation. So depreciation is 80,500 per year. This is your depreciation. Okay, so all these are the information from the question itself. So now, the first question. Hey, calculate the accounting break-even point. To calculate the accounting break-even point, you see how many quantity that you are selling here to break even. Okay, is it within the 71,000 or what? So that's something that we need to find out. So to count the accounting break-even point, the formula is to find the quantity. So quantity is equals to fixed cost plus depreciation divided by price minus the current price minus the variable cost. This is the formula. Remember this to count the quantity to break even. Okay, so fill in the blanks. Fixed cost $725,000 plus depreciation 80,500. The price currently is $37. Your variable cost is 21. Okay, so this will give you an answer of 50,344. Oops. And this amount is the unit to break even. So to break even, you need to sell 50,344,000 at 50,344 units to break even. Okay, this is part A. All right, part A. Moving on. Space on part B. Moving on, part B. Calculate the base case, cash flow, and NPV. What is the sensitivity of NPV to changes in the sales figure? Explain what your answer tell you about a 500 unit decrease in projected sales. So they want you to count the base case now. The base case, now they want to do base case cash flow and NPV. So basically they want you to count your NPV. All right, the base NPV. All right, so the original NPV lah. So to count NPV, very easy. Something similar to what we did last week. All right, to count NPV, the first step, you need to find your OCF first. Okay, to find OCF first. All right, you need to find your cash flow. So OCF formula, we've seen it many times already, is equals to P minus variable cost multiplied by quantity. For this question, there's quantity minus fixed cost multiplied by 1 minus tax plus tax multiplied by depreciation. Okay, this is your operating cash flow. All right. The key selling price minus your cost multiplied by 1 minus T. So why he got so many things? So this is a price minus variable cost. This is for quantity. Then there's a fixed cost. That's why minus again. So this whole total is actually the price minus the fixed cost. You get your net cost multiplied by your tax. Again, your tax shield and tax depreciations. Again, minus your tax amount plus your tax depreciation. Sorry, your tax shield your depreciation shield. So this formula, remember this, to count OCF, where the questions give you the quantity, okay, this is how it looks like. Price minus variable cost multiplied by quantity minus the fixed cost, multiply 1 minus the tax plus tax times depreciation. This is a depreciation tax shield. Okay, so this question, so this is OCF of the base. So this question, everything is given to you. Price at 37, variable cost is 21. Quantity 70,000. Fixed cost 725,000. Close bracket. 1 minus 0.35. Okay. Plus 0.35 multiplied by depreciation 80,500. This will give you an operating cash flow of 284,925. Okay, 284,925. What is the year of this thing? 8 years life. Okay, 8 years life. So this will be for the next 8 years at 15% required rate of return. Okay, so having this already, you can calculate your NPV. So there's no salvage value. Salvage value is 0. So you find your OCF and you can find your NPV. Okay, so NPV, basically, if you use calculator, you can use your calculator. If no calculator, negative $644,000. This is the cost. Plus 284,925 PVIFA at 8 years and 15%. Then you get your answer. Those with calculator, just input your CFO. Okay. CFO negative 644,000. C01 284,925. F01 frequency of 8 times. Interest 15%. Compute NPV. Okay, compute NPV. So NPV will give you 634,550.08. This is your base, or this is your NPV of this project. All right. So the problem here is they want you to check the sensitivity of the NPV. Okay, what is the sensitivity of NPV to changes in sales figure? So they want to see how NPV changes if your sales figure changes. So this is something that you need to test now. Okay, how do you test that? Do again the whole NPV by do again the whole OCF by changing the sales figure now. Okay, to find out what is the sensitivity, to see how much of changes will cause the changes on your NPV also. Okay, so what do you change here? All right, initially 70,000. So now you change your unit. Okay, so your new OCF now, you change the question a bit. Your OCF, the price is still the same, 37 minus your cost variable is 21. Quantity you change now. Instead of 70K, you put 71K lah, 1K extra. Okay, the rest remain the same. Minus 725. 1 minus 0.35 plus 0.35 multiplied by your depreciation. So this new OCF that you get is 295,325. So got this. This is new OCF. Then new NPV. Same thing. But now your cash flow is different already. Still for 8 years and 15%. So calculator, also do the same thing. CFO, negative 644,000. C01, put this new figure in. F01, 8 times, interest 15%. Compute NPV. New NPV you get here is 681,218.22. So by changing the quantity, okay, by changing your quantity, your NPV from 634,550.08 become 681,218.22. So 1,000 different, it goes up by almost 50K. Okay, so we're going to see the exact sensitivity of each unit changes in the sales. So now to count the changes of NPV, our changes of sales. Okay, the old NPV is 634,550.08. Then it changed to 681,218.22. This is because the change of unit from 70,000 to 71,000. Okay, 70,000 to 71,000. All right. So what is this figure? Okay, you should be getting negative how much is this? 46668 divided by negative 1,000. So negative become positive. Okay, this shows every 1 unit growth. Okay, this is 1,000 unit difference. 1,000 unit difference, it causes a change of 46,668. Okay, your NPV goes up by 46,668. All right, so each unit increase on sales will give you 46.668 increase in your NPV. This is what it means. I hope you understand this. Okay, each 1 unit increment in sales will give you an increment of NPV 46.668. Okay, so based on the question again, the question tell you what happened if there's drop of sales by 500 unit. Okay, then what happened to your NPV? All right, explain what your answers tell you about 500 unit decrease in projected sales. So what happened if your sales drop by 500 unit? So easy, you know each unit represents 46.668. So if let's say a drop in 500 unit, so it's negative 500 unit, multiplied by 46.668, this will give you negative 2334.07. So this is not your final NPV. Yeah? This shows that your NPV will drop by 23,334.07. This is the amount that your NPV will be affected if it's dropped by 500 unit sales. Okay, so it doesn't matter. The quantity change is 71,000 here, right? So it doesn't matter to do this calculation here. You can put any figure. You want to put 75,000, you want to put 80,000, you put 81,000, is up to you. You in the end, you will still get back the same answer because the divided quantity will be the same. The difference here will be still divided by the amount of quantity in the end of the day. So it's up to you to determine it. Okay, so there's no restriction that it must be 71,000. It could be 75, it could be 72, with 72,500. You want to put 72,001 also can. You will still get 46.668 per increment of quantity sold. Okay, so up until here, Any question? Any lost students so far? I see in the chat it's still very quiet. No issues, huh? Quiet means I assume no problem. Okay, all good, very good. So, all right, I hope that is clear. So let's move on then, if no issues. The next question here, C. What is the sensitivity of OCF to changes in variable cost figure? So just now you talked about it changes of NPV. What do you mean is changes of NPV or changes of unit sales? Changes of NPV, changes of unit sales. Yeah, correct lah. I don't know what you're trying to ask on Souchen. Yeah, please be more clear if you're asking what you want to know. Okay, let me know if you have any questions. I will read it after that. So back to C. What is the sensitivity of OCF to changes in variable cost figure? Explain what your answer tell you about 1%, $1 decrease in estimated. Why is there percentage? Why do you want to convert to percentage then? You can use percentage over percentage change of revenue. No, percentage change of sales. Where is the revenue come from? Either way, you will get some kind of figures which will affect your NPV. So now you need to see how does it affect your NPV. So why do I want to change it into percentage? All right, I'm trying to see the changes on the NPV. How does it affect the NPV? And then, so yeah. So now the question is telling us to find the changes of sales that affect the changes on NPV. So I don't need to convert it into any percentage or whatsoever. I just want to find how is my NPV affected by each sales increment or each sales decrement. So it's a very straightforward thing. So I don't need to change it into revenue, or I do not need to change it into percentage. It's quite straightforward from the question here. Okay, so back to C. So the sensitivity of OCF to changes in the variable cost figure. So now, just now we are talking about changes of quantity sales to affect your NPV. So now the next question here, they want us to see the change in your variable cost to affect your OCF. So look back at the base question here. This is the new, yeah, the base question here. This is the base one. So now instead of changing the quantity keeps 70K. We want to find how the VCs, this one, the variable cost changes affect your OCF in whole. Okay, this is the next thing that we want to see. All right, so I'll just do it side by side here. Okay, OCF of the base we already got. Now you need to find the sensitivity. Explain what your answer tell you about 1% decrease. So you can go and straight away put decrease to so. Okay, but you just need to calculate what is the difference here. So the figure of the variable cost initially is 21, right? Now you can put it. You want to put 25, you want to put 30, you want to put 35, you want to put 21, you want to put 19. It's up to you. You get the same figure. Okay, you get the same figure. So this OCF new here. All right. You use back the same formula. Okay. So we do increment lah, same like quantity. Quantity increase 1,000. This one we increase by 1 also. Minus by 22. 21 become 22. So increment of 1 also. So standardize everything increase by 1 unit. Okay. Minus 725. Same thing. 1 minus 0.35. Plus tax 0.35 multiplied by your depreciation 80,500. So these new changes give you a new OCF of 239,425. Okay, 239,425. So previously, oops. Previously is 284,925. Now 239,425. Okay, so you see the changes of how it affect for each $1 change in variable cost. So find the difference of OCF divided by the difference of variable cost. Okay, the old OCF is 284. Just now you see 284,925 minus 239,425 divided by old OCF is 21. Now is 22. So on top here you get 45,500, and then here's -1. Okay, so the answer is -45,500, which means every increment of 1 unit, your cash flow, all right, will drop by 45,500. All right, will drop by 45,500. But let's say the question now asking you what happened if is the what is the answer, will tell you about if it's a 1%, $1 decrease in estimated variable cost. So instead of 21, it becomes 20. So drop by 1. So since just now we calculated every $1 increment in your VC, in your variable cost, it will affect a drop of 45,500 in your OCF. Increment of $1. But the question say if $1 drop in your VC, then your OCF will goes up by 45,500 lah. Okay? The OCF will go up by 45,500. Cannot. Okay, got it, huh? So no issues. I think can move on. So this is counting sensitivity. Very straightforward. No need to change to any percentage. I don't know what is in your slides, but no need to change to any percentage or don't need to change to any other forms. It's very straightforward. Just calculate it like that. Okay. So question number 2 here is basically the continuous of the question number 1. The previous problem, suppose the projection given for price, quantity, variable cost, and fixed cost are all accurate to plus minus 10%. Calculate the best case and worst case scenario NPV figures. This is a bit more challenging. Okay, so look back at this one. This is the base. Okay, this is the base. This is the formula of base. Never mind, I do it again to show you the difference. All right, so your base question just now, okay, take back your OCF of your base, the equation. The OCF of your base question, okay, take back the formula, P37 minus 21 times 70,000 minus 725, 1 minus 0.35, plus tax 0.35 multiplied by depreciation 80,500. This is the original figure. Okay. Now the question wants you to find you the best case scenario, which is plus 10%, minus 10%, and worst case scenario. So what is the best case scenario and worst case scenario? OCF of best. Best case scenario means the price that you sell are now better off by 1.1%, increased by 10%. Okay? And then Your variable cost, which is 21 initially, become cheaper by 10%. Okay, close this bracket. Your unit sold just now is 70,000 unit. Now it's better off by another extra 10%. Okay, minus your fixed cost of $725,000. Now it's at a better condition, which is decreased by 10%, and tax remains the same. Depreciation also remains the same. So this is what he meant by best case scenario. The good thing will increase. So sales amount, sales price is increased by 10%, quantity increased by 10%, and your costing all will be decreased by 10%. This is the best case scenario. Okay, plus minus 10%. So your new OCF of your best case scenario is 695,140. Okay, so with this figure, they want you to find the NPV of the best. You can use a standard negative 644,000 plus 695,140 PVIFA. Everything remained the same, 8 years and 15%. Okay, if you use calculator, no need me to repeat, just key in. And in the end of the day, you get 2475,316.67. Your best case scenario will give you an NPV of 2 million plus. All right. Now, your worst case scenario, OCF, worst case scenario. Okay, same thing only. Just now that the percentage you count is different. 37, instead of multiply by 1.1, it becomes 0.9. Minus 21, increase 1.1. Okay, multiply by 70,000. Unit also drop by 10%. Cost will go up. Cost went up. Depreciation remains same. This gives you a new OCF of worst, which is negative 72,510 for next 8 years. So now calculate the NPV of the worst case scenario. Negative 644,000 minus 72,510, 8 and 15%. So if you use a calculator, I'm going to show you again. Negative 969,375.68. So now we already got our worst case scenario. Worst case scenario and our best case scenario. So when it comes to best case and worst case scenario, they tell you the percentage plus minus percentage there. Means you add on, if it's best case scenario, means selling price quantity increases by 10%. Your costing all decreased by 10%. But if it's the worst case scenario, selling price quantity also drop by 10%. And then your cost and your variable and your fixed cost both also increase by 10%. Then you get a new set of OCF and you calculate the NPV. So over here, the worst case scenario of this project, you either going to get 2.5 million or you're going to get negative 1 million, almost $1 million. So this is worst case versus best case scenario. All right. Can follow, cannot follow. Can follow, cannot follow. Okay, very good. Only Zarin can follow, the rest cannot follow. All right, never mind. So no one asking questions. I assume also okay, but Zarin is very sure got no issues. So moving on to question 3 here, they give us a table. Okay, they give us a table here. I hope that you have the question with you. So look at the table together with me. In each of the following cases, find the unknown variable. Ignore the taxes. Okay, ignore the taxes. So let's see what the information given to us. Accounting break even, unit price, unit variable cost, fixed cost, and depreciation. Okay, so what they want us to find? They give you accounting break even already. Okay, so very simple. This question basically, they already tell you what to do. Accounting break even means they want you to use this formula. Quantity, okay, equals to the first equation that we use just now, plus depreciation, divided by the selling price, the selling price minus your variable cost. Okay, so you see the first question there, they give you 95,300. Question 1. Quantity 95,300 equals to FC, fixed cost 820,000. Depreciation don't know. We need to find depreciation. Divided by unit price 41 minus variable cost of 30. So find B. So find B. Okay, this one will give you B equals to 228,300. 228,300. Second question. Second question, they give you everything. They want you to find P. Okay, break even, they give you 143806. Fixed is 2.75 million. Depreciation is 1.15 million. Price don't know. Cost 56. So price to in the end get $83.12. The last one, they give you 7835. Fixed cost 160,000. Depreciation 105,000. Price is at $97. VC we don't know. So in the end your V 63.18. This one is actually very easy, just do simple maths. Okay, just do simple maths. No rocket science. Just use the formula I give it to you. This is the formula. All right. So I'll move on. I'll move on. To question number 4. LG Toys Incorporation just purchased a $390,000 machine to produce toy car. Cost $390,000 machine to produce toy car. The machine will be fully depreciated by the straight line method over its 5 years economic life. Find the depreciation. Okay, here is 78,000 per year. All right, standard lah. They never tell you to find, already. They tell you straight line depreciation over 5 years. Fully depreciated to 0. So every year is equal. So divided by 5, you get your depreciation first. Then each toy sells for $25. Selling price $25. Variable cost $11. Fixed cost $280,000. Corporate tax rate 0.34. Appropriate discount rate 12%. What is the financial break-even point for the project? Okay, what is the financial break-even point of the project? All right. So you want to see how many quantity that you are selling, which were equivalent to NPV equals to 0. Okay, break even means NPV equals to 0. All right, you want to get your NPV equals to 0. So this question, you use your NPV, the break even accounting break even formula, but it's a bit more complicated. All right, it's a bit more complicated because they take into consideration of tax rate, they take into consideration of fixed cost, okay, and take into consideration of discounting rate also. So what you need to do now, all right, this formula which we used just now, Q equals to FC plus D divided by price minus VC, it's being made much more complicated. So this will end up becoming like this. Okay, this will become okay. What is EAC? Equivalent annual cost plus fixed cost, okay, times 1 minus tax minus depreciation, okay, times tax. EAC plus FC minus depreciation tax shield. So this whole thing divided by your price minus your variable cost. Same like just now, price minus variable cost, but now take into consideration of your tax. Okay, take into consideration of your tax. So this question now, you got your FC, you got your depreciation, we already calculated just now. You got your price, you got your variable cost, and you got your tax. So the only thing missing here is EAC. Okay, EAC. So what is EAC? EAC is effective annual cost. So EAC is equals to initial investment divided by PVIFA. Okay, initial investment divided by PVIFA. All right, this is how you want to find it, to find EAC. Okay, this is first method. Initial investment divided by PVIFA. The second method to find PVA is this formula. PVA is equals to PMT times 1 minus, okay, 1 over 1 plus R power of T divided by R. These two formula, you can use either one of it. Okay, so the EAC for here is PMT. All right, so PMT is equals to EAC. So two methods, up to you. See which one you want to use. All right, see which one you want to use. Both will give you the same answer. All right, so for this method, if you use means is basically take $390,000 initial investment divided by PVIFA. This is for 12% and is for 5 years. So 5 years and 12%. The answer. As for this, your PVA is 390,000. PVA is 390,000 equals to PMT unknown multiplied by 1 minus 1 plus R. R is 0.12. Power of T is 5 years divided by 0.12. So 390,000 divided by this whole thing, you get your PMT. So both will give you your PMT or your ESC equals to 108,189.8. Okay, 108,189.8. So once you got this, all right, you can fit into these calculations. Okay, so now fit into it. Let's try. ESC we calculate just now 108,189.8 plus the question fixed cost is 280,000. Yeah, 280,000 times 1 minus 0.34 minus depreciation. We calculated just now 78,000. Okay, 390,000 divided by 5 is $78,000. Multiplied by your tax 0.34. Divided by the price. Selling price just now, we got it is at 25. Variable cost 11. 1 minus 0.34 again. Okay, so this whole figure will give you the quantity to break even, or the quantity to get NPV equals to 0. So the quantity to give you NPV equals to 0 is 28,838.72. So you need to round this up lah. So you need to sell 28,839 units to get NPV equals to 0 to break even. So your break even amount is 28,839. So okay, any questions so far? So come on, you guys, if you have questions regarding that particular question that we discussed, you better ask me straight away. Because once I move on to the next question, I already erase off whatever we have been discussed before that. Then we can go back. Okay, so please let me know if you have issues on the spot. Any issues so far? Any students lost? No issues. Okay. Make sure really got no issue. If got issue, you want to come back, we cannot come back because once I erase it out, it's gone. Okay, the only way for you to retrieve feedback is via the YouTube channel. All right. So we move on to the last question today, which is the probability trees. So this last question might be a bit confusing to some students, but let's go through it together and slowly. B&B has a new baby powder ready to market. Okay, if the firm goes directly to the market with the product, there's only 55% chances of success. However, the firm can conduct segment research, which will take a year and cost 1.2 million. By going through research, B&B will be able to better target potential customer and will increase the probability of success to 70%. Okay, if successful, the baby powder will bring a present value at time of initial selling of 19 million. If unsuccessful, the present value payoff is only 6 million. Should the firm conduct customer segment research or go directly to the market, the appropriate discount rate is 15%. Okay, so what happened here is they're telling you there are two things in it. All right, so this company wanted to sell something. Okay, so they are thinking, should they do research or not? All right, should they do the research or not? Okay, so this is at the initial stage. So research, if there's no research, there's only a 55% of success. and 45% of fail. Okay. All right. Okay. If there's no research, there's only 55% of success and 45% of fail. Okay. But let's say no research means no lah. Here continue on, no research already. And then your profit will only be $6 million. If let's say no research, also 55% success, but if you got research, it increased to 70% of success. All right. And then 30% of fail. So fail will lead to profit of 6 mil. Success will lead to profit of 19 mil. This is how it looks like. This is how it looks like. Huh? No research, 55% success, 45% failure. If fail means only 6 million. And then if you do research, the 55% success rate become higher. It becomes 70% now. And then 30% fail only. So if you successfully, you gain 19 million. If not, it's only 6 million again. Okay. All right. So now the problem with the company, they want to identify, should the firm conduct a segment research first or should they directly go to the market? Okay. So in this case, you need to find the probability for both scenario. All right. You need to study the both scenario. So the first scenario here is to count if there's no research. Okay, you need to count the probability of no research. This section. All right. So when there's no research, okay, there's a so the first thing, the first scenario, when there's no research, when no research. The NPV, okay, the NPV of your no research will be this. There's a 55% of you gaining 19 mil. All right. And a 45% of you gaining only 6 mil. So what is the NPV here? 13,150,000. Okay. The next one, the next one is telling you if the customer segment research, they tell you, that's one is the next one is going to research. When no research, when there is research. But remember, when you research, there's an initial cost 1.2 mil. Okay, so now you need to delay 1 year or so. Okay, you need to discount it by 1 year then because it's discount by 1 year. All right, because it's a delay by 1 year. So you next one, instead of getting only 55% chance of getting 19 million, you need to increase the success rate. So in this case, you want to do research first, and this research will cost you time and money. First of all, it will cost you what do you call that? $1.2 million. So you count the NPV here. NPV with an initial cost of $1.2 million. Okay, then your probability increase definitely. Your probability increase by 19 mil multiplied by 0.7% plus 6 mil multiplied by 0.3%. Look at the table, look at the graph here. 70% success, 30% fail. Okay, 30%. So this whole thing needs to be discounted by 1 year. 1 plus 0.15 power of 1. Because delay 1 year. So you can only get back your cash flow 1 year later. This is negative. Okay, initial investment. So this new NPV will give you the determination should you do research or not. So the NPV here is 11,930,434.78. Okay, so you can see now. All right, you can see now. One, without research, yeah, NPV of 13 million. With research, you are having an NPV of 11.9 only. Okay, so in this case, very simple to make the decision making. They should just go into the market straight. No need to do research. Full stop. So no need to waste time doing research, delay 1 year, and then getting a lesser NPV. And then you need to invest 1.2 million. All right. So going to the market straight will be much more profitable. Okay. So that's the final question for today. And that's the wrap for today also. Any questions so far? No question. Very good. Okay. Those with issues